When markets rise at an unstoppable pace, it feels like we're witnessing history in the making. Everyone's excited, everyone's making money, and everywhere you look, people are convinced this time is different. But if you peel back the layers, the signs are hard to ignore: extreme valuations, euphoric investors, and a growing disconnect between price and reality. The Indian stock market is no exception. Right now, we're not just seeing growth, we're seeing the classic warning signals of a bubble forming. And the thing about bubbles is that they always look like opportunities until they burst. Valuations today are sitting at levels that simply don't make sense when compared to the underlying fundamentals. Many companies are trading at price to earnings ratios that would require them to grow at an unrealistic pace for years just to justify their current prices. In some sectors, stock prices have doubled or tripled while actual earnings have grown only modestly, if at all. That disconnect between price and reality is what creates fragility. When the optimism is high, investors are willing to pay almost any price, assuming the growth will eventually catch up. But history shows that when growth doesn't materialize as expected, prices fall much faster than they climbed. A common mistake investors make during these periods is believing that momentum equals value. Just because a stock has gone up consistently doesn't mean it deserves the price tag it currently has. For example, certain companies in the technology and financial space are priced as though they will dominate their industries without any setbacks. The reality is that competition, regulation, and economic slowdowns can all chip away at those assumptions. High valuations leave no room for error, which means even a slight miss in quarterly results or a hint of weaker demand can cause sharp corrections. Another red flag is the way broader indices have been climbing in sync, and even when individual company earnings don't support the same level of enthusiasm. That indicates the market is being driven more by sentiment than fundamentals. Investors buying at these inflated levels are not just purchasing shares, investment. They're buying into expectations that may never be met. And when expectations collapse, the fall can be brutal. This is why stretched valuations are often the earliest and clearest signal of a bubble forming in any market. What's driving much of the current surge is not just institutional money, but a wave of retail investors who have entered the market with high hopes and little experience. With easier access to trading apps, social media hype, and stories of quick profits, a sense of frenzy has taken hold. People are no longer asking whether an investment makes sense. They're buying because everyone else is buying. This herd mentality can push prices higher in the short term, but it also creates instability. Because when sentiment flips, that same crowd rushes to the exit at once. Cheap credit and margin trading are adding fuel to the fire. Many new investors are borrowing money or using leverage to magnify their bets, chasing bigger gains without considering the risk of bigger losses. The problem with leverage is that it works both ways. Just as it amplifies profits when prices rise, it magnifies losses when markets dip. A small correction can quickly wipe out entire positions, forcing people to sell at a loss and dragging prices down further. This cycle of panic selling can turn what looks like a small pullback into a full-scale market crash. FOMO, the fear of missing out, is another powerful force at play. When people see their friends or influencers showing off big gains, they feel pressure to jump in, often at the worst possible time. Instead of analyzing companies or thinking long-term, decisions are being made on impulse. Investment history has shown again and again that markets fueled by emotion rather than fundamentals are fragile. The current retail-driven enthusiasm in the Indian stock market looks less like smart investing and more like speculative gambling. And bubbles formed this way rarely end well. The real danger with bubbles is that they don't need much to burst. A single shift in global or domestic conditions can trigger a chain reaction that sends markets spiraling downward. Right now, interest rates are one of the biggest pressure points. As central banks raise rates to control inflation, borrowing becomes more expensive. That directly affects both companies and consumers. Businesses face higher costs of capital, and individuals have less disposable income to spend or invest. When growth slows, earnings shrink, and suddenly the lofty valuations investors were willing to pay no longer seem reasonable. Inflation is another critical factor. Rising prices erode purchasing power and weaken consumer demand, which directly impacts company revenues. If profits start missing expectations quarter after quarter, confidence in the market erodes quickly. At the same time, when global economic uncertainties, from geopolitical tensions to supply chain disruptions, can amplify the problem. For an interconnected market like India's, even a downturn in the US or Europe can have ripple effects as foreign investors pull money out of emerging markets to seek safer assets. The issue is not just that these risks exist, but that they often converge at the same time. A slight slowdown in growth, combined with high inflation and rising interest rates, can flip investor sentiment almost overnight. And because the market is currently built on optimism rather than fundamentals, the correction can be swift and painful. The higher prices are pushed by speculation. The sharper the fall tends to be once reality sets in. That's why global and domestic economic pressures are often described as the pin that pops the bubble. It doesn't take much. Just the right amount of pressure at the wrong time. When markets appear unstoppable, it's tempting to believe the best strategy is to keep riding the wave. But the most successful investors know that protecting capital matters more than chasing short-term gains. In times like these, risk management is not optional. It's essential. That begins with diversification. Instead of putting all your money into a few hot stocks or sectors, spreading investments across different industries and asset classes reduces the impact of a sudden downturn. A balanced portfolio can cushion shocks when specific areas of the market correct sharply. Equally important is sticking to long-term fundamentals. Companies with strong balance sheets, consistent earnings, investment, and clear growth strategies are more likely to withstand volatility. Hype-driven investments may look attractive in the short run, but when conditions shift, they're often the first to collapse. By focusing on businesses that create real value rather than inflated stories, investors can avoid the worst consequences of a bubble burst. It's not about timing the market perfectly. It's about owning assets that remain resilient regardless of the cycle. Discipline also plays a critical role. Setting stop-loss levels, avoiding excessive leverage, and resisting the urge to double down on speculative bets can prevent small mistakes from becoming financial disasters. Many investors lose money not because they pick bad companies, but because they ignored risk controls when emotions took over. In a market fueled by excitement, staying rational becomes your biggest advantage. Ultimately, bubbles don't last forever, and when they burst, only those with sound strategies come out stronger. The goal is not to predict exactly when the downturn will come, but to prepare as if it could happen tomorrow. By managing risk and staying grounded in fundamentals, investors can protect their wealth while others are swept away by the crash.